Chapter 10, Liabilities. Some of these items presented in Chapter 10 will be a review. We've talked about liabilities of different types throughout this course, so some of this, like I said, will just be a review. We're going to look at what current liabilities are, and you know a lot of this already. We're going to talk about notes payable and other types of liabilities. We're going to then introduce into this course the discussion of bonds and what bonds are. They are a type of liability. We're going to look at the different types of bonds, entries made as we issue bonds, and then we're not going to spend a lot of time talking about bond redemption or conversion, but bonds, when they are redeemed, that means they're paid off and converted. Some bonds are convertible to common stock, but we're not going to spend really any time with that. And then again, we've got other long-term liabilities, notes payable, and the last thing we're going to look at is some analysis of some different long-term liabilities. Okay, as we discussed before when we talked about our classified balance sheet, we defined a current liability as a liability or a debt that the company expects to pay back within the next 12 months or the operating cycle, whichever is longer. And as we discussed back then, most businesses' operating cycle is less than 1 year. So, rule of thumb, a current liability is a debt that the company is going to pay back in the next year. And you see some different types of current liabilities here shown in the yellow highlighted box. You've seen a number of these before. We'll look at them very briefly here in a moment. But first, a question. To be classified as a current liability, a debt must be expected to be paid within answer's D, 1 year or an operating cycle of the business, whichever is longer. A note payable would be considered a current liability if the note, the amount borrowed, is going to be paid back within the next 12 months. Again, there's going to be interest involved with our notes payable. We're going to sign a promissory note, promise to pay the money back within a certain period of time, and again, there's going to be interest involved. If it's going to be paid back in the next 12 months, it's a current liability. So in this example, this company borrows $100,000 on a 4-month note, so it's going to be a current liability. 12% interest rate, going to mature, or the note's going to become due on January the 1st. We're going to look at the entries associated with this particular set of transactions. When the money is borrowed, we're going to debit cash because our cash is increasing. We're going to credit notes payable. Our liability is increasing. Then if we make our adjusting entry for accrued interest that's owed as of December the 31st, again, we're not going to pay this note back until January the 1st, so if we're doing our financial statements at year end, we need to record the interest costs that have been incurred on this note since we borrowed it on September 1st by debiting interest expense and crediting interest payable. And then finally, when the note is paid in full, we're going to go in and debit notes payable, debit interest payable for the $4,000, and then credit cash for the amount of cash we have to pay back to the bank on the maturity date of January the 1st. All right, sales tax payable is another type of current liability. When we first talked about merchandising businesses in Chapter 5, we didn't deal with the sales tax issue because we had a wholesaler selling goods to a retailer, and sales taxes are only paid at the consumer level. So when a retailer sells their inventory to consumers and they collect the tax from the customer, this creates a liability to the retailer because that money that they're collecting from their customers does not belong to them. It belongs to typically the state government. So let's look at an entry for that here in just a second. All right, this company or this retailer on this particular day had sales of $10,000 for which they'd collected sales tax of $600, sales tax rate of 6%. This would be the journal entry the retailer would record. They're going to debit cash for the amount of cash that they received that day. They're going to credit their sales revenue account for the $10,000 in sales, and they're going to credit sales tax payable for the $600 that they have collected from their retail customers. Again, when this money is sent on to the state government, this business will go in and debit sales tax payable for the $600 and credit cash, or actually more than that, because typically that's done on like a monthly basis. So they'll take that month's sales tax collections and send it on to the state. Okay, if a business does not keep their sales tax separate at their cash register, and they show total receipts that day of $10,600, of course they know they've been collecting taxes, but they don't know how much, they can determine this by taking the total amount received and divide it by 1 plus the sales tax rate. So because the amount they've received represents 100% of the sales and 6% sales tax. So 106% is this 1.06. So you divide the total amount received by that 1.06. That will give us our sales revenue for that day. And of course the difference between the amount received and the sales revenue will be the sales tax that we've collected. So we debit the cash $10,600, credit sales revenue $10,000, credit sales tax payable for the $600. All right, the next current liability, you will remember when we talked about payroll accounting, all the taxes that are collected from the employees, withheld from the employees' paychecks, create liabilities to the employer. So we looked at the different types of liabilities were created, and then we had another liability affected when we recorded payroll, that salary and wages payable. We'll look at an example. Well, actually, this slide just shows a review of, remember we had our gross pay, which is what the employee has earned. We subtract all of our different payroll deductions, our mandatory deductions, our FICA taxes and federal income tax and state and city income taxes if there are any. And we also deduct these voluntary deductions that we would have to come up with what the net pay was. This is an example of an employer who's recording its payroll for this week ending March 7th. You're going to debit salary and wages expense for the total gross earnings of the employee. You're going to credit all the different liability accounts for all the amounts that were withheld from the employee's paycheck. And the amount of the net pay is what we credit salary and wages payable. This is the money we owe to our employees. When we pay our employees, obviously we go in and debit that liability and credit cash. You might also remember from the appendix where we talked about payroll is that because of that payroll that the employer had just run, they also have to pay the employer's portion of the payroll taxes. We'll look at the example of that entry here on the next slide. Remember, the employer has to match the FICA taxes, the Social Security and the Medicare taxes, and also the 2 unemployment taxes, the federal and state unemployment taxes. This is the example of an entry made by an employer to record the employer's payroll expenses. We have the matching FICA taxes, we have the federal unemployment tax payable and the state unemployment tax payable, and our debit to our payroll tax expense is the total of all 3 of these. A review question. I think we had this review question back in Appendix H. Anyway, employer payroll taxes do not include federal income taxes. The employer pays the FICA taxes and the 2 unemployment taxes. Okay, another type of current liability is unearned revenue. If you will remember, unearned revenue is when a business receives payment for either services that that we're going to perform or goods that we're going to deliver, but we receive the payment in advance before we ever deliver the goods or provide the service, this amount received represents a liability to our business. Again, if we don't do the work or deliver the goods, the expectation is we would have to refund the money to the customer. So until we do the work or deliver the goods, we record this amount received as a liability called unearned revenue. And you see some different examples there at the bottom of this slide. So our university here has sold 10,000 season football tickets at a cost of $50 each for its 5-game schedule. So again, payment is made in advance. So this university is going to debit cash for the amount of cash that's received and going to credit an unearned revenue account, in this case called unearned ticket revenue, for the $500,000. If the first game is played on September the 7th, once that game is completed, then this university has provided the service of one of these 5 games. So we're going to recognize 20% of this unearned revenue as revenue. We're going to go and debit unearned ticket revenue for $100,000, credit ticket revenue for $100,000. Of course, this entry would be made after each of the home games have been played. This slide shows another type of current liability called current maturities of long-term debt. So if we have a long-term liability, but some portion of that long-term liability is going to be paid within the next 12 months, that portion of this long-term debt will be shown as a current liability. So in this example, they have a 5-year interest-bearing note of $25,000. The note says that we're going to pay back $5,000 in principal every year. Then we're going to record that $5,000 that's going to be paid within the next 12 months as a current liability of $5,000. The remaining portion of this will show up on our balance sheet as a long-term liability. This next slide shows Caterpillar Incorporated. They make heavy machinery, and the different assets they're shown on their balance sheet, and then all the different current liabilities. Again, everything on this balance sheet is expressed in terms of millions, so we need to add 6 zeros to each of these numbers, but you can see the different types of current liabilities that Caterpillar Inc. has. Okay, this slide shows calculation of what's called working capital and a liquidity ratio called the current ratio. Working capital is calculated by taking your total current assets and subtracting your current liabilities. That shows that this company has working capital of $12,769. So they have $12,069 current assets above their current liabilities. The current ratio is current assets divided by current liabilities. It basically says for every dollar of liability, we have $1.43 available in our current assets. As any other ratio, looking at the current ratio doesn't tell us anything without comparing this current ratio to this company's previous year's current ratios to see what the trend of their liquidity is. Also, we could compare our current ratio to our chief competitors or to some type of industry average. Quick question. Working capital is calculated as current assets minus current liabilities. All right, let's take a look at long-term liabilities. Again, a long-term liability is a debt that a business is going to pay beyond 1 year, beyond 12 months. So it could be a note payable that we're paying back beyond 12 months. It could also be a bond. A bond is a type of security that corporations can issue, can sell, which represents debt. So there's basically 2 types of securities. There's debt securities, bonds, and there's equity securities, stock. So when a company issues stock, that represents ownership in the company. If they issue bonds, That's a form of debt. So if someone buys a corporate bond, when a corporation issues that bond, they are basically loaning money to that corporation. There's going to be interest involved with the bond. It'll pay interest to the bondholder. Typically that's done semi-annually. You'll see listed here 3 advantages that bonds would have over a company issuing stock. Again, if they have the choice of issuing one or the other to raise cash in order to expand their operations or for whatever they need the cash for. Obviously, the one advantage bonds have over stocks is that they don't give up any ownership, because again, bonds represent debt, so no ownership is given up. There can be a tax savings because interest that corporation pays to the bondholders is tax deductible. It's an operating expense, and so it reduces net income. Therefore, there's a tax savings. And because the number of shares outstanding is used in calculating the return on common stockholders' equity, which is a profitability ratio, because less shares are outstanding, that's going to keep the return on common stockholders' equity higher. Of course, one of the disadvantages that bonds have versus stock is that the money must be paid back. The principal amount of the bond has to be repaid to the bondholder, and then the interest payments that have to be made over the bond term. So you have to repay that. Stocks, you don't have to repay the stockholders anything. You don't have to pay stockholders dividends. So that's one of the disadvantages. Here's a side-by-side comparison of a company that has issued stock to get cash versus a company that issues bonds. Obviously, the company that issues bonds gets to deduct the interest, which lowers the net income and will obviously lower their tax liability. And you can see more shares are outstanding for Plan A because they've issued shares of stock, and because the number of shares of stock outstanding is also used in the calculation of earnings per share, which is basically net income divided by your outstanding shares. It's going to give issuing bonds is going to keep your earnings per share higher, if that's important to the company. Okay, here's a question. Major advantages resulting from the use of bonds are: that interest must be repaid, or that interest must be paid to the bondholder, and then also the principal must be repaid when the bond matures. This slide shows some different types of bonds that corporations can issue. They can issue a secured bond, or the bond could be unsecured. If the bond is a secured bond, that means there's collateral backing the bond. In other words, if they default on the bond when it becomes due, then the bondholders can seize the assets that are backing up the bond and sell the assets and get their money back. So if they're building a new factory, the factory building might be used to secure the bond. That's collateral. Unsecured bonds are just basically there's no assets backing them. So it's basically issued based upon the credit of the corporation issuing the bonds. Bonds can be convertible bonds. Some bonds are convertible to common stock at some point in the future. Some bonds are considered to be callable bonds. In other words, the bonds can be repaid early at the issuing corporation's, that would be their decision. It's not the bondholder's decision. So if the company that issues the bonds decides we want to pay these bondholders off sooner, if they're callable bonds, that can be done. The primary reason this is done is if there is a decrease in interest rates. So let's say the company issues some bonds that are paying 5% and interest rates drop, then they can pay off those bonds early. They could even issue some new bonds at that lower interest rate and use that money to repay the former bondholders. You'll see school districts do this from time to time as interest rates change, and they call the bonds and pay them off, and again they've issued new bonds to pay those bondholders off to get a lower interest rate. when a company decides it wants to issue bonds, it's going to have to go through some of the same approval process that they have to issue stock. State law governs the issuance of bonds just like state law governs the issuance of stock. Board of directors, stockholders would have to approve the bond issue. Board of directors would determine how many bonds they're going to issue, what's going to be the face value of those bonds, and they're also going to determine at that time the contractual interest rate. This is the rate that's going to be paid to the bondholders. This is the interest rate that's going to be paid to the bondholders who hold those bonds. There's going to be a contract set up as the bonds are issued called a bond indenture. That's going to describe all the details of the bonds. And again, most bonds are going to be held in electronic form now, not so much in a paper certificate anymore. So basically, if the bonds get issued, they are sold to the individual or the organization who's purchasing the bonds, and they pay for that. Again, the bond will be paying a contractual interest rate. It will state how often that's going to be paid, usually semi-annually. Okay, and then it talks here about reasons why bonds are issued. And again, they can go through an investment company to issue the bonds, or they could sell the bonds directly to the bondholders. This is an example of a paper certificate, a paper bond. This is how bonds used to be issued. Again, most of them are done electronically now, but you can see the name of the company issuing the bonds, when the maturity date, what the contractual interest rate is, what the face amount of the bond is, $5,000. So again, this is an example of a paper certificate. When we get to chapter 11, we'll look at a paper stock certificate as well. Again, you don't see a lot of paper certificates anymore, as most things are held electronically. Okay, bonds can be traded on the different exchanges just like stocks can. So I can go to my stockbroker today and I could say I want to buy such and such company's bond. Well, I won't be buying that bond from the company. I would be buying it from someone who owns that bond, who might have bought it from the company, but now they're wanting to sell it. So bonds are traded just like stocks are traded. And here's how bonds are quoted if you're looking at the quoted price. Here you've got Boeing Company, who at some time in the past has issued some bonds, and the contractual interest rates on those bonds, they're paying 5.125%, 5 1/8. It tells the maturity date here. It says the previous day the bonds closed at 96.595. Okay, this means they're not trading at face value. They're trading at less than face value because interest rates have increased. Because interest rates have increased, this 5 1/8 bond is not as attractive an investment as bonds that are paying a higher interest rate. So in order for this bond to be sold, you have to offer it at a lower price. We'll talk about that more here in a few minutes, about what causes bonds to increase and decrease in value. But you can see the yield on that bond is a little bit higher than the 5.125. It's yielding 5.747, and this is the number of amount of bonds that were traded the previous day. Okay, how's the market value of the bond determined? Well, it's going to be determined based upon three things. How much money is going to be received? Okay, we're going to be looking at the present value of our cash flows related to a bond, and obviously how long the term of the bond is. And then what's going to really drive it is going to be this market interest rate. What's the current market interest rate as we compare it to the contractual interest rate on the bond? And again, market interest rate is defined as the rate that investors demand for loaning money at that moment. Okay, this slide shows when a company makes entries into its accounting records related to bonds. Obviously, it's going to record a transaction when it issues or sells the bonds. When it redeems the bonds, it buys the bonds back from the bondholders, that's going to require the company to make an issue. And if they're convertible bonds, if the bondholders convert their bonds into common stock, that's going to require them to make an entry. The company will also make an entry in its accounting records related to the interest being earned by the bondholders on the bonds, and obviously when that interest is paid. When a person who has bought a bond from the company later on sells it to another investor, there is nothing for the company to record. That's between the two different individuals in this transaction. So once a bond is issued and it's out there in the marketplace, when it's being bought and sold out in the marketplace, there is not an entry that the company who has issued the bonds has to make. Now, this slide is going to talk about the contractual interest rate of a bond and the market rate. When a corporation decides it wants to issue bonds, it sets that contractual interest rate, and there will be some time that goes by before the bonds actually get issued. So we make the decision we want to issue on what our interest rate is going to be, and there's going to be a little time lag. So when the bonds get issued is a later time than when it's determined the contractual interest rate. So what happens in the market between those two times is going to determine whether the bonds are sold at a premium, a discount, or at face value. So let's say this company has set their contractual interest rate at 10%, and at the time they actually issue or sell the bonds, market interest rates have fallen down to 8%. Well, if the current market rate is 8% and I've got a bond that I'm selling at 10%, that's going to be a very attractive investment for an investor. So I'll be able to issue these bonds at a premium, at a higher price, because of this change in interest rates. If the current market interest rate is at 10%, which is equal to our contractual interest rate, I'll be able to sell these bonds at face value. But this third item here, if market interest rates have gone up, now currently investors are demanding 12%, and my bond is only paying 10%. That's not going to be a very attractive investment for an investor. So in order for the bonds to be sold, I'm going to have to offer these at a discount. Otherwise, they're not going to buy my bond. They're going to go buy a bond that's paying 12%. So this is the scenario which creates whether bonds are issued at a premium, face value, or a discount. What has happened to market interest rates and how those compare to the bond's contractual interest rates. All right, here's a question. The rate of interest investors demand for loaning funds to a corporation is the market interest rate. Another question. Carson Inc. issues 10-year bonds with a maturity value of $200,000. If the bonds are issued at a premium, this indicates that the contractual interest rate exceeds the market interest rate. This bond that we're issuing now is very attractive to investors because the contractual interest rate is greater than what's currently being paid out in the marketplace, so we can charge a higher price or a premium when we issue these bonds. All right, let's look at some journal entries that a company would make as it issues bonds. In this instance, on January the 1st, we're issuing 100,000 5-year bonds that a contractual interest rate of 10%. We're issuing those at 100 or 100% of face value. This means that the contractual interest rate is equal to the market interest rate as we're issuing them. So we're going to debit cash because we're going to be receiving $100,000 from the bondholders. And we're going to credit bonds payable, this long-term liability account of $100,000. Okay, when we go to pay the first semi-annual interest payment on July the 1st, we're going to debit interest expense for $5,000 again, 10% interest rate on $100,000. Annual interest would be $10,000 since we're paying semi-annual interest. We're paying $5,000, and we'll credit cash for $5,000. Okay, on December the 31st, as we're about to prepare our annual financial statements, we're going to make an adjusting entry to record the accrued interest on these bonds by debiting interest expense and credit interest payable for $5,000. We're making this entry because we're not going to make this interest payment until January the 1st. So at December 31, we need to record the accrued interest on these bonds up through December the 31st. Now, let's look at the entry we would make if we were issuing these bonds at a discount. This means that the contractual interest rate is lower than the market interest rate. So in order to entice or encourage the investors to purchase our bonds, we're going to have to offer it at a discount. We'll look at how that discount is calculated here in a minute. We're going to debit cash for the $92,639 that we were receiving because, again, we're selling these at a discount. We're going to debit a contra liability account called discount on bonds payable of $73.61, and we're going to credit bonds payable for the face value of the bonds. As we make interest payments on this bond over the life of this bond, we're going to be reducing this discount on bonds payable because we're going to be paying interest on the $100,000, but we really only borrowed $92,000, so our effective interest rate is actually going to be higher than 10%. As we get closer to the maturity date of this bond, this discount on bonds payable will be reduced down to 0. This is how we would present these account balances on under our long-term liabilities on our balance sheet. We would show the face amount of the bonds payable less the contra liability account, the discount on bonds payable of the $73.61. This $92,639, that's called the carrying value of the bond. This slide just shows the total cost of borrowing the money if we issue them at a discount. Again, we're going to make the semi-annual interest payments of $5,000 for a total of $50,000, and we add that bond discount of the $73.61. So the total cost of our borrowing is going to be the $57,361. Again, the total cash paid is going to be $150,000, but we only received $92,639 because we issued the bonds at a discount. Again, that kind of proves the cost of the borrowing there. Okay, here's another question. Discount on bonds payable. Is a contra account. It's a contra liability account. Now let's look at the entry a company would make if it issues bonds at a premium. Remember, bonds will be issued at a premium if interest rates have fallen below our contractual interest rate. So now our bond is a very attractive investment and we can charge a higher price for it. Again, the calculation for that is done. I'll look at how that's done here in a minute, but we're going to debit cash for the amount of cash we receive. Again, we can sell these at a higher price. We're going to credit bonds payable for the $100,000, and we're going to credit an account called premium on bonds payable. This is not a contra liability account. This is called an adjunct account because it's going to be added to the bonds payable to show the carrying value of our bonds. And this is how that premium on bonds payable would be shown on our balance sheet. Again, our bonds payable plus our premium on bonds payable shows our carrying value now to be $108,111. as we're making interest payments throughout the term of this bond, this premium on bonds payable will decrease till when we get to the maturity date of the bond, it will be down to zero. Because again, we're paying interest on only the $100,000, but we received $108,111, so our interest costs are going to actually be less. And this slide shows our total cost of our borrowing. Again, we're going to be making 10 $5,000 interest payments for a total of $50,000. Subtracting out the premium we received when we sold these bonds or issued these bonds of $8,111, so the net cost of our borrowing is only $41,889. Again, we can show that a different way. $100,000 plus the $50,000 in interest payments. This is how much is going to have to be paid back to our bondholders over the life of the bond. We received, though, when we sold the bonds, $108,111. So this, again, is another way of showing our total cost of borrowing, issuing these at a premium. Okay, accounting for our long-term notes payable. Again, when we borrow money on a long-term note, we're going to be debiting cash, crediting a long-term liability account. We're going to be making interest payments on this long-term note payable over its term. In many cases, these long-term notes payable are going to have a monthly payment associated with them, and so this company will be making a monthly payment. A certain amount of it will be principal, a certain amount of it will be interest, kind of like a home mortgage payment is made from a personal standpoint. You start paying on that mortgage, and each month you pay a little principal and a lot of interest, and then over time that principal balance gets lower and lower, so you begin paying more and more principal and less interest as time goes by until you reach the final days of paying off that loan. All right, this schedule shows on a $500,000 12% 20-year mortgage payable, and this company is making semi-annual installment payments of $33,231. So as you can see, over time, more and more principal is being paid off and less interest. So the principal balance is reducing. So the amount of interest that would be paid in the next semi-annual period is going to be less because we're paying it on a lesser principal balance. So let's look at the journal entries. We debit cash for the $500,000. We're going to credit mortgage payable. It's a long-term note payable because there's a mortgage. It's used to buy real property, which is buildings and land. It's called a mortgage. So our long-term note payable, called a mortgage payable here, we're just increasing our asset account, increasing our long-term liability account. On that first interest payment, that $33,231, we owe $30,000 in interest. We're going to reduce our principal balance on our mortgage of $3,231, and of course we're crediting cash for the $33,231. Okay, a question. Each payment on a mortgage note payable consists of correct answer is interest on the unpaid balance of the loan and a reduction of the loan principal. Okay, this slide shows two different long-term liabilities, a bond payable less the discount on the bonds payable. Again, this is our carrying value of our bonds payable, and this company also has a long-term liability, a mortgage payable of $500,000. Any portion of this mortgage payable, if we're making monthly payments, we're going to show that the principal that's going to be paid over the next 12 months within our current liabilities called current maturities of our mortgage payable. So we would, if any of this $500,000 was going to be repaid in the next 12 months, we would include that balance in our current liabilities and reduce our long-term liability by that amount. Okay, two financial ratios that kind of relate to liabilities are debt to assets ratio and times interest earned ratio. These two ratios are considered to be solvency ratios. Solvency ratios give us an indication of whether we think the company is going to be able to last for the long run. Okay, you've heard the term insolvent. A business becomes insolvent. That means they become bankrupt. So these solvency ratios, again, they don't tell us if a company is going bankrupt, but it gives us an idea if they were headed in that direction. Okay, the debt to assets ratio is total liabilities divided by total assets. Basically, this ratio tells us what percent of our assets are financed by our creditors. In this case, in Kellogg Company, 79.7% are financed by our creditors. Well, what that also means is that 20.3% of our assets are financed by our stockholders through our stockholders' equity. So the higher this percentage is, the greater risk the company is putting itself under. Okay, so the more and more debt we take on and the less and less equity we have makes it a higher risk venture. Now, we can't really look at this 79.7% and determine if Kellogg is hurting or not, but what we would want to do is look at the debt to assets ratio for this company over the last 6 or 7, 8 years. And we look at the trend of this debt to assets ratio. If it's trending upward, then this company is undergoing more risk. If it's coming down, then we would say the company is less risky. This next solvency ratio, called times interest earned, gives us an indication of whether basically the company's ability to meet its interest payments as they come due. And you can see the formula here. Net income plus interest expense plus income tax expense divided by interest expense gives us this times interest earned. And the thought process here is if a company is not very likely to make its interest payments, then it's probably heading toward bankruptcy. Think of it from a personal perspective. You have a credit card and you charge some things on your credit card, and you get your monthly statement and you look at how much you owe and you look at how much interest the bank is charging you for what you owe. And if you can't even make your interest payment, well, then you've got some serious financial difficulties. So this basically tells how the company whether the company has the ability to meet its interest payments, and it can meet its interest payments 6.71 times. Once again, looking at this one ratio, this one times interest earned, we really can't tell too much without comparing it to this company's times interest earned from previous years. What kind of trend are we seeing? We could also look at compare that to its competitors' times interest earned to determine what kind of risk it's under. Okay, these next couple of slides talk about how to calculate the present value of a bond. It's also used to calculate the discount or premium on a bond as we're issuing them. So to determine the present value or the selling price of a bond, we're going to look at the present value of the two cash flows related to the bond. And each bond is going to have two different cash flows. The monies that come in when we sell the bond, and obviously when we redeem the bond, the monies are going out. But we're going to look at how much money is coming in, and also the present value of the interest payments. So let's look at an example of that here. This slide shows our two different cash flows related to these $100,000 10% 5-year bonds. We're going to have semi-annual interest payments, and we're going to have the principal amount due at the end of that 5th year. So two different cash flows. You'll remember a few slides back we looked at when bonds are issued. We're going to be looking at the contractual interest rate and compare it to the market interest rate called the discount rate here. And as you can see, when the contractual interest rate and the market interest rate are equal, then we issue these bonds at face value. And that can be proven by taking the present value of the principal amount of the bond and adding it to the present value of the interest payments. If you'll remember back in the Appendix A, we looked at, Appendix G, we calculated present value using those two tables, present value of one table, which is the present value of a single amount, and we looked at the present value of an annuity of 1. Well, we would use the present value of one table to calculate the present value of this single amount. We would calculate the present value of the interest payments using that present value of an annuity of one table. So again, this proves that when we issue our bonds when the contractual interest rate is equal to the market interest rate, then we're issuing these at face value. Now, we've got a 10% contractual interest rate, but the market interest rate is higher, 12%. We're going to use those same two tables, the present value of one table and the present value of annuity of 1, but we're going to be using this 12% interest rate in those tables. So we calculate the present value of the principal amount, and it's $55,839. We calculate the present value of an annuity of 1. Again, we're using the same 12%, and the present value of those interest payments is $36,800, giving us the present value of our bonds at issuance of $92,639. The difference between the $100,000 face amount and this $92,639 is the amount of the discount when we issue the bonds. That's how that discount was calculated. And finally, our example, if we issue our bonds with a contractual interest rate of 10%, but interest rates have fallen, the market interest rate is 8%. If you'll remember, we said that makes our bond a very attractive investment. We can charge a premium. We're going to use the present value of one table to determine the present value of this single amount due at maturity, but we're going to be using this 8%. We're going to be in the 8% column on that present value table, and we're going to be using that same 8% on that present value of annuity of one table to calculate the present value of those interest payments. And this is how we determined or came up with that premium of $8,111, issuing them at that premium. That's all for Chapter 10.